triathlon over there. All right, thank you, Cheryl. Market volatility has been huge as we watch this global sell-off. Well, we're up for now. Futures pointing to a higher open this morning, with everyone still wondering what led us to here. My next guest says the commodity markets are to blame for the big sell-off. He says they will go even lower from here and says deflation talk will intensify. RJ O'Brien, Managing Director. John Brady joins me now from Chicago. John, love getting your perspective on these markets. Great to talk to you as we see this futures pointing to another big gain this morning. You're saying commodities led the dramatic sell-off?
No, absolutely, Sandra. You know, it started with crude oil late last summer with new embargoes on Russia and Middle Eastern oil. You had the Saudis flood the oil market, but most commodity markets have followed the move in crude oil and really followed the two-year down move in gold. I think the thing to keep in mind is that the commodity cycle, which peaked in 2013, 2014, never really approached the highs of the commodity cycle in 2007, 2006. And thus, from a technical perspective, the lower lows made in the commodity cycle this time round suggests that we could get pressed a little bit further lower in the commodity markets, specifically China's economy continues to slow.
John Brady, Keith McCall is chomping at the bit to ask you something here.
It's because, John, I haven't talked to you since Pipes and I were with you last. It's been a long time. Good to see you. Just wanted to ask you quickly on the very short-term catalyst for commodities versus the dollar. Do you see anything coming in Jackson Hole, i.e. Draghi devaluing, or anything that could knock the dollar around and have that flow through to the commodity side?
You know, Keith, I don't, and that's a great question. Thank you. I think the single most important thing in Jackson Hole this weekend is that global central bankers present this sense of calm and being in charge, looking past short-term gyrations in the markets and taking a medium and longer-term view. I think Stanley Fischer's the guy to do it. They'll project calm coming out of Jackson Hole this weekend.
So you think Fischer's actually going to say something?
I think he's going to prepare the markets for the idea that we just maybe have not reached Nehru yet here in the U.S. employment markets, and thus inflation really hasn't responded as Fed officials had hoped, let's say earlier this year and in 2014. So they may sort of punt this idea of normalization into Q1 2016.
Mm-hmm. Hey, John, I want to get John Brady. I want to get this breaking news in here on this durable goods orders and the idea that this is driving U.S. stock index futures even higher ahead of the open. We're looking at a 375-point gain on the Dow right now. S&P 47-point gain. Traders see higher chances now, John, of the Fed raising rates by year end after this stronger than expected July U.S. durable goods report that just came out?
I think if so, Sandra, I think that trade may be a short-term fade. You know, numbers such as retail sales and durable goods really aren't going to affect the Fed's decision as much as, say, employment markets and inflation data. So we may see a little bit of a modest uptick this morning in pricing for the Fed move. But really, at the end of the day, the two drivers are going to be employment and inflation, followed closely by global market volatility and financial conditions.
If they did, John, what's interesting to me with the macro data, everybody all of a sudden is a macro expert, but they actually don't know what the data is. If you look at I just tweeted it, so I tweeted the durable goods data. If you look at it on a year-over-year basis, which is the growth rate, durable goods went into a recession in February. I mean, this number was up sequentially, but it's down 20% year-over-year. So isn't that part of the calculus? Retail sales, durable goods, year-over-year, we're seeing a significant slowdown underneath the hood that the Fed is actually concerned about.
Well, Keith, you're right, and it's not just that; it's the stronger dollar trade, right? I think in July, Boeing reported maybe 101 plane orders compared to June at 161. You know, Airbus is slowly eating market share given the lower euro currency globally. So,
great point.
No, I think the stronger dollar trade and higher embedded real rates plays a role in that story.
All right, John, I'm going to ask you now because otherwise you're going to get a phone call from me and, after we get off the air asking this question because I love your perspective. Do we finish today higher, as it's pointing right now, up 363 for the Dow futures, or do we have another dramatic sell-off in the last hour?
So there are a couple things. First, there was a little bit of a calming influence in the overnight, Sandra. Market was very concerned that China would have it down 7% last night. Shanghai only finished down 2%. More importantly, the topics and the Nikkei both finished up 3%, and European equity markets are lower marginally this morning. I think it'll be a little bit of a technical trade. I think 1921.50 in S&P futures, that's where S&Ps were trading yesterday when the PBOC made their announcement. 1952 is your high from Monday. We kind of failed there yesterday at 1948.
Right.
And of course, down below 1850 is your overnight low in futures. But I think also to keep in mind, yesterday's late afternoon sell-off was really due to a very large market on close cash imbalance sell order of close to $3.5 billion. I don't think we get the repeat of that today, so I think equity markets will stabilize.
All right, great stuff. All right, John Brady, great to have you on. Thanks for joining us this morning. Great color on the markets.